Welcome to TaxLawGH and welcome to our video on the taxation of partnerships and trust. By the time you are at the end of this video, you should know everything there is to know about taxation of partnerships and the taxation of trust in Ghana. First thing we'll take a look at is what are the rules governing taxation of partnerships in Ghana. Then we move on to taxing trusts in Ghana. How does our Income Tax Act define a partnership? The law says a partnership means an association of two or more people, or individuals or corporations, that carry on business jointly for the purpose of making profit, irrespective of whether the association is recorded in writing. So take note, whether or not it's a documented arrangement, whether or not it's on paper, whether or not it's in writing, as long as you have two or more individuals or corporations coming together to do business jointly for the purpose of making profit, then we say you have a partnership in place. What are the rules governing taxation of partnerships in Ghana? There are a number of key principles that we will summarize here so that you know what the Income Tax Act really says about taxation of partnerships in Ghana. First thing to take away is that a partnership on its own is not liable to pay income tax with respect to the chargeable income of the partnership and is not entitled to any tax credit with respect to that income. But the partnership is liable to pay income tax with respect to final withholding payment. Now, the concept of final withholding payment has been explained in our withholding tax series of videos. The concept of chargeable income has been explained in our income tax basic principles videos. So if you've not watched those, please do. But quick recap, chargeable income is a person's assessable income for the year from business, employment, and investments, less any allowable deductions under the Income Tax Act. When we talk about final withholding payments, these are payments that after suffering withholding are not liable to any further tax obligations down the line. Summary for those who need a quick refresher. What must you remember from here? A partnership as an entity, it's on its own or by itself, is not liable to tax. As we'll find out shortly, the tax flows down to the individual partners. So remember, a partnership is not liable to pay income tax with respect to chargeable income, and they are not entitled to any tax credit. The only tax they are required to pay really relates to final withholding payment, remember. Also, the income of a partnership or a loss of a partnership is to be allocated to the partners. That is a key principle. So when it comes to partnership taxation, work out how much income is liable to tax, but you don't tax at the level of the partnership. You share the profit or the loss between the partners in accordance with what we call the profit or loss sharing ratio, and that is where, in the hands of the partners, is where the tax liability arises. They are saying also that an amount derived and any expenditure incurred by a partner for and on behalf of the partnership in common is treated as an amount derived or expenditure incurred by the partnership and not the individual partners. So if a single partner of the partnership goes to derive an amount or goes to incur an expenditure and they derive or incur this on behalf of the partnership, then the law deems this amount incurred or this amount derived or the expenditure incurred as being incurred or derived by the partnership itself and not the partner. So partners have the right, or they are able to go out there, and if they act as agents or as partners of the partnership, then whatever they do will be tied to the partnership as an entity. Similar to amounts derived and expenditure incurred, also any asset owned or any liability owed by a partner for and on behalf of the partnership in common is treated as an asset or liability of the partnership itself and not the individual partners. So if a partner goes to acquire an asset, and in acquiring that asset, he does it in his capacity as partner, that asset he acquires is treated as an asset owned by the partnership entity and not the individual partner. Same way, if a partner goes out to incur a liability, let's say he goes for a loan, and he incurs this liability on behalf of the partnership in his capacity as partner, this loan or this liability will be deemed as a partnership entity liability and not of the individual partner. Remember this. We are saying this will also be treated in the case of asset and liability. If it's an asset acquired, it will be treated this way when the asset begins to be owned. If it's a liability incurred, when the liability begins to be owed in that particular way. That's the time when it is deemed as being owned by the partnership or being owed in case of a liability by the partnership entity. It will also be treated as realized when the asset ceases to be owned or the liability ceases to be owed in that particular way. So upon realization, obviously, there could be a gain or loss on that realization. We are saying here that the activities of a partnership are treated as conducted in the course of a single partnership business. So regardless of what any partner is doing anywhere, we try to streamline everything together as being done by a single partnership entity in the course of conducting their partnership business. Also, an arrangement between a partnership and its individual partners is recognized and taken into account in determining the share of any individual partner. So whatever arrangements the partnership and the partners have, whether it comes to how do we share profits and loss, how do we contribute capital, how do we withdraw capital, what their rights are with respect to everything, the law is saying that that arrangement will be taken into account when it comes to determining the share of an individual partner for the purpose of taxing that partner on their income earned from the partnership. Remember, our principle here is that a partnership as an entity is not taxed on its own, but the income flows into the hands of the partners themselves, and in their capacity as individuals, that is when the amount to be taxed. We are saying this provision above does not apply to a loan that is made by a partner to the partnership and any interest paid on the loan. So we are saying that an arrangement between a partnership and the partners will be taken into account in determining the share of a partner. However, it does not apply to where the partner gives the partnership a loan. That's a separate standalone agreement. So whatever agreements they have on that perspective of on that angle is what will apply. Any interest paid on that loan will be treated separately. Also, any service a partner provides to the partnership, including the employment of the partner, and any service fee or income from the employment will also be treated separately from this provision of all arrangements to be taken into account. Also, we are saying where there's a change in the partners of a partnership and at least two existing partners continue, then the partnership is treated as the same entity before and after the change. Very important to remember this. So let's say you have a partner of 20 partners, you have a partnership of 20 partners, and there's a change in the number of partners. Let's say 17 partners leave. The law is saying if at least two of the partners continue to be partners, then the partnership has not changed. So we treat the same partnership as the same before the change and after the change, and there's nothing to happen from the perspective of tax impact. So remember that as long as you have two existing partners staying as partners of the partnership, then wherever there's a change in the number of partners, we treat the entity before and after the change as what? The same entity or the same partnership. Now that we know this, how does the law determine partnership income and partnership loss? We are saying the income of a partnership for a year of assessment is the income of the partnership from the business of the partnership for the year. So what business does the partnership engage in? What is their main trade or their main activity? Whatever they are registered to do. Don't forget, our definition of partnership is an association of two or more individuals who come together to jointly do business for the purpose of making profits. So if that is the case, then whatever business they are engaged in as a partnership, whatever income they make from that business is what the law will deem to be the income of the partnership entity. How about the loss? Same principle. A loss incurred by a partnership for a year of assessment is the loss incurred by the partnership from the business of the partnership for the year. So what does the partnership engage in? Whatever they do, that is their main or principal activity. If they make a loss from that activity, then the law deems that loss to be the partnership loss for the purpose of determining tax payable by the partners of the partnership. How do we tax the partners themselves? I've already mentioned a number of times that the partnership itself as an entity is not taxed, and they are not entitled to tax credits except for what? Final withholding payments. However, we tax the partners themselves and the income they derive from the partnership. For the purposes of calculating the income of a partner from a partnership for a year of assessment, the person doing the calculation shall include the share of a partner of any partnership income or deduct the share of that partner in any loss incurred by the partnership for the relevant year. So, if you are a partner and you are a partner of a partnership where, let's say, you are three partners, profit and loss sharing ratio is, let's say, 50, 25, 25. So, you, the guy, getting 50%, whatever we determine as partnership income for the year, obviously, to go through the usual partnership calculation from accounting, so we determine the profit at the end of the period, and then we share it according to the profit and loss sharing ratio. So you get 50%, your other two partners will get 25, 25, whatever the magic ratio is. It is that 50% that comes to you as a 50% partner that will be taxed in your hands as well partnership income. So we are saying here that it includes a share of that partner of their partnership income. If it is a loss they made, then we deduct their share of that loss incurred from the partnership. So it flows through to the partners, and that is where the taxation occurs. The relevant partnership year for the purpose of this is the year of assessment of the partnership, ending on the last day of assessment of the partner or during the year of assessment of that partner. We said, if you remember from our income tax basic principles videos, we said the year of assessment for everybody else is the calendar year, which is January to December. We said for individuals and partnerships, if you remember, their basis period is what, also January to December. Just a quick revision if you've forgotten already. As in, a person who calculates the income of a partner shall treat a gain on the disposal of an interest of that partner in the partnership as income from a business, and shall include that income in the calculation of the income of the partner. If you are a partner and you have an interest in a partnership, what does interest mean? It's simply your share or proportion to the partnership. How much capital have you contributed? How much, I'm using the word loosely, but how much equity in quotes have you contributed to the partnership? That is your interest in that partnership. If you decide to sell your interest, you decide to sell your proportion of the partnership to someone else, any gain you make on that disposal will be treated as what? Business income. Take note, and taxed accordingly in your hands as a partner. Subject to some rules I'll discuss shortly on the cost of and consideration received for partnership interest, any gain specified I just mentioned as being treated as business income will be dealt with under Part 4 under assets and liabilities. So if you've not watched our videos on taxation of gains, please do so. We talk about the concept of capital gains or gains on disposal of capital assets and liabilities. You can watch those ones. But key takeaway from here is that taxation of partners, it's in the hands of the partners themselves. Then we use the year of assessment of the partnership and the partners as basis for determining the taxing period. And then where there is a gain on the disposal of what the interest of that partner in the partnership, we treat this as income from a business, and we include this in calculating the income of that partner. In addition to this, income of a partnership or a loss incurred by a partnership is allocated to the partners, and it retains its character as to the type and source. So whatever income it was at the partnership level is what will flow down to the hands of the partners. It's just to be fair, it's just a movement of income. It's also treated as an amount derived or expenditure incurred by a partner at the end of the year of assessment, and is allocated to the partners in proportion to their share, unless the Commissioner General by notice in writing orders otherwise. So what we are saying here is we will stick to what your profit and loss sharing ratio according to your partnership agreement is, unless the Commissioner General orders otherwise. So the default is to use the profit and loss sharing ratio in your agreement. You sign as partners. If not, then the CG can prescribe another way of sharing profits and losses. By saying also that tax paid under the Income Tax Act and any foreign income paid or treated as paid by a partnership in relation to the income of the partnership is allocated to the partners in proportion to the share of each partner and treated as paid by the partner. So any tax that is paid under the Income Tax Act in relation to partnership income and any foreign income tax paid by the partnership at the partnership level will then again be allocated to the partners. So everything that happens at the entity level flows through to the partners. If you forget anything at all, just remember this, that the tax for the taxation of partners happens in the hands of the partners and not at the partnership level. Also, we need to remember that an allocation of this amount I just spoke about occurs at the time partnership income is treated as derived by the partners. Also, the share of a partner, to confirm, is equal to their percentage interest in any income of the partnership as set out in the partnership arrangement. I've mentioned this already. So whatever the partnership arrangement says the share is, if you are eligible to 20%, 40%, 75%, whatever you guys agreed to is what you will be given. So remember this, very important. How is the partnership interest valued in terms of the cost and consideration received? Remember I told you your share or ownership in the partnership is deemed as an interest. If you are leaving and deciding to transfer or sell it, you can make a gain, and that gain is treated as business income. How do we value that? I'm saying the following are included in calculating the cost of the membership interest of the partner of the partnership. What would you include in the cost? The amount included in calculating the income of that partner at the time of inclusion of that amount, and the share of any exempt amount and final withholding payment of the partner derived by the partnership. So to find your cost or the cost base to determine how much your membership interest or partnership interest is worth, we take into account any amount included in calculating the income of the partner and any share of exempt amount and final withholding payments, just to allocate on the basis of your ownership interest. Then how do we value your consideration received, or how much you actually realized your membership interest or partnership interest for? We include the following in consideration received: any amounts deducted in calculating your income. So obviously your consideration received will be adjusted for any amount you deducted in calculating your income as a partner. We'll also include any distribution made by the partnership to the partner, and any share of domestic or excluded expenditure of the partner. Remember, these domestic and excluded expenditure are what you find under section 130 of the Income Tax Act. So these will also be adjusted from the consideration received to arrive at the final consideration received number and the final cost number. And then when we net off consideration received and cost, if consideration received is more than cost, then obviously there's a gain the partner has made on his disposal of his interest in the partnership. So this what the law provides when it comes to partnership. Very simple concept, very easy to remember. Just take note of this. Let's move on to the taxation of trusts in Ghana. Very simple principles, very easy to remember. How or what must we know when it comes to taxing trusts? Before we even talk about the principle governing taxation of trust, what is a trust? How does the law define a trust? I'm sure some of you are wondering, what is a trust? The law says a trust means an arrangement under which a trustee holds assets. Hold on a second. You know what assets are. You know what arrangement means. You know what to hold means. So who is a trustee? Let's define a trustee, and that will probably help us understand all of this. We are saying any arrangement under which a trustee holds assets is a trust. So who is a trustee? So a trustee means an individual or a body corporate holding assets in a fiduciary capacity for the benefit of identifiable persons or for some object permitted by law, and whether or not a number of things. Remember, any individual or body corporate that holds assets in a fiduciary capacity for the benefit of identifiable persons is a trustee. What is the fiduciary capacity? What's a fiduciary capacity? What it essentially means is to hold something on behalf of someone and in the interest of that person, and not for your own individual or personal interest. So you are actually acting as a fiduciary. You are holding something in the utmost interest or utmost benefit of someone else and not yourself. This is a very basic explanation of what it means. So you are there to represent the person and not to serve yourself, right? You are there to ensure someone's interests are furthered beyond your personal interest. So any individual or body corporate that holds assets in a fiduciary capacity for the benefit of individual or identifiable persons or for some object permitted by law is a trustee. And we are saying whether or not those assets are held alone or jointly with other individuals or bodies, or whether or not the individual or body corporate is appointed or constituted trustee by personal acts, by will, by order or declaration of a court or other operation of law. And it also includes an executor an administrator, a tutor, or a curator. It includes a liquidator, a receiver, a trustee in bankruptcy, or a judicial manager. It also includes a person having the administration or control of assets subject to usufruct, and fideicommission or other limited interests. These are legal terms. If you are interested, just check the dictionary. Don't bother too much at your level. What you need to remember here is that for a trustee, we are saying any individual or body corporate that holds assets in trust, or technical term, in a fiduciary capacity. So when we say someone holds something in trust for someone, then it means it's a fiduciary capacity, but let's use the word as is used here. In a fiduciary capacity for the benefit of someone else, then that person's a trustee. So going back to the definition of trust, we are saying anybody who holds assets in this fiduciary capacity under an arrangement is deemed to be what? A trust. Also, under a trustee, we are saying a person who manages the assets of an incapacitated individual is also deemed to be a trustee, and a person who manages assets under a private foundation or other similar arrangement is a trustee as well. So, key takeaway point from here is that a trust is an arrangement under which a trustee holds assets. And we know what a trustee or who a trustee is from this definition. Now that we know this, what's the principle around taxing trusts? We are saying a trust on its own is liable to tax separately from the beneficiaries of the trust. Who are the beneficiaries? These are the people for whom the trustee holds the assets in a fiduciary capacity for. The persons who are the ultimate beneficiaries of all the assets or whatever is under management of the trust. So the trust as an entity is liable to tax separately from the beneficiaries of the trust. First thing to remember. The next is where a group of persons are trustees for more than one trust. The income of each trust is supposed to be calculated separately, regardless of the fact that the trusts have the same trustees. So let's say you and your friend operate as trustees for the same trust. We are saying that despite the fact that the two trusts that you guys manage have the same trustees, each trust will have to be what? Or the income of each trust will have to be separately identified, separately calculated, despite the fact that they are managed by the same trustees. A person who calculates the tax liability of a trust is required to treat the trust as an entity. If you go to section 133 of the Income Tax Act, it defines an entity to include a trust. So this is the law just reiterating something is already said. Treat the trust as an entity when you are determining taxation. We are saying this principle does not apply to the trust of an incapacitated individual. So where you are dealing with a trust that covers an incapacitated individual, then in that case, you will not treat the trust as an entity. So take note, the general principle is we treat a trust as an entity for the purpose of income taxation. However, if the trust relates to a trustee managing the trust of an incapacitated individual, then there's a different rule. What is the rule for incapacitated individuals? We are saying a person who calculates the tax liability of a trust of an incapacitated individual shall treat the trust as though it were an individual. So remember, taxing an incapacitated trust is kind of similar to individual income taxation, whereas all other trusts are treated as an entity for the purpose of calculating income for or tax for the trust or at the trust level. Also, a person shall treat an amount derived and any expenditure incurred by a trust or a trustee as an amount derived or expenditure incurred by the trust. If you remember the principle from partnership, we said when the partner goes to incur an expense or goes to derive an income amount on behalf of the partnership, what do? We treat those amounts as though they were derived by the partnership and not the partner. Same principle here, where a trustee goes to derive an amount or incur an expenditure, then we deem it to be done by the trust itself. I'm saying this applies whether or not the amount is derived on behalf of another person and whether or not the other person is entitled to that amount or income. So if a trustee or a trust itself acts on behalf of the trust and goes to incur an expenditure or derive income, this is deemed as though it was done by the trust itself. A person is supposed to treat an asset owned or a liability owed by a trust or a trustee as an asset or liability of the trust itself. Same principle as for a partnership. We are saying these two principles, where we are saying you treat amounts and expenditure derived as done by the trust and you treat assets and liabilities as that of the trust, do not apply if the trustee is now acting as an agent of the trust. So take note, under agency arrangement, this principle does not apply. And also similar to what we had under partnerships, any arrangement between a trustee and the trust and its beneficiaries will be given legal effect. So the law will give effect to any arrangement that subsists. Whatever you guys have agreed as trustees, trusts, and beneficiaries, the law will hold that as valid for the purpose of determining the tax of the trust. So remember this for the trust level. How do we tax the beneficiaries of the trust? Those who are the ultimate beneficiaries, those for whom the assets are held on behalf of in a fiduciary capacity. How do we tax them? The law says if a trust distributes, let's take that again, if a resident trust distributes to a trustee, then a distribution of that resident trust is exempt from taxation if the distribution is in the hands of a beneficiary of the trust. So take note, for a resident trust, where they make a distribution to a beneficiary of the trust, that resident trust, then that distribution is exempt from income tax if the distribution ends up in the hands of the beneficiary of the trust. So remember, resident trust, where they make a distribution to a beneficiary, then that distribution in the hands of the beneficiary of the trust is exempt from income tax. However, a distribution of a non-resident trust is included in calculating the income of the beneficiary of the trust. So if you're a trust and if you are a beneficiary of a trust, and a non-resident trust pays you or makes a distribution to you, obviously from the assets held under trust, then that non-resident trust distribution to you will be included in calculating your income as beneficiary and will be taxed accordingly. Also, any gain on the disposal of the interest of a beneficiary of a trust is included in calculating the income of the beneficiary. So if as a beneficiary, your interest in the trust is disposed of, and as part of making that disposal, you end up making a gain, then that gain is included in calculating your income from the disposal or for the year as part of disposing your income or disposing your interest in the trust. So to summarize, we have looked at the principles governing taxation of partnerships and the principles governing the taxation of trust. These are what are provided for in the Income Tax Act of 2015, Act 896. So let's end here. That's all you need to know on the taxation of partnerships and trust, and we'll look a lot more at partnership taxation, and we look at the computational aspects at the end of the series of videos. So if you love this, as usual, don't forget to smash the like button. Don't forget to share this video within your entire network. I'll catch you in the next video.